Good evening, everyone, and thank you for coming tonight. The investment industry likes to talk in terms of averages. Average returns, average valuations, average outcomes. In reality, most of the time, financial markets tend to swing back and forth between extremes over economic cycles. In fact, since 1928, there have really only been 6 years where the S&P 500 returned between 8 to 12% in a given year, a level that's typically associated with long-term average returns. 55% of the time, annual returns were above 12%, and 27% of the time, they were below zero. Now, while 8 to 10% may seem like an appropriate return expectation over a decade, achieving this outcome in a single year is kind of like going deer hunting with 3 statisticians. One shoots to the left, one shoots to the right, and the third said, "We got it on average." Now, in 2025, the market environment continues to drift further from the average towards the extreme on many accounts. The S&P 500 is up around 16% year to date, and if it ends the year about 4 or 5% higher, it will be just the second time in modern history that the market has returned above 20% in 3 consecutive years. The only other instance of this was during the tech bubble in the late 90s. From a policy perspective, 2025 has marked the biggest shift in US trade policy in a century. The US fiscal position continues to veer into uncharted territory along an unsustainable trajectory, and the Federal Reserve's independence has been challenged more than it has in decades. Not surprisingly, 2025 has seen the highest sustained uncertainty in economic policy on record. Now, this is all against a backdrop where there's a rapid pace of change and innovation in artificial intelligence that's continuing to drive global equities higher towards some of the highest valuations in history. But for all of these extremes, in some respects, the current environment really looks quite similar to past economic cycles and market cycles. So the current cyclical bull market that began from the interim low in 2022 actually looks relatively average in terms of its size and its duration compared to past historical bull markets. It's risen about 85% over 36 months relative to the average of about 90% over 30 months. Like other bull markets, equities are being propelled higher by a narrow group of businesses that are perceived winners alongside a pronounced capital expenditure cycle. Now, weakening employment trends also look somewhat similar to historical later stages of the economic cycle. Central banks, similarly, are cutting interest rates in an attempt to engineer a soft landing. And as is typical, the consensus among economists is that they'll be successful in these efforts, despite a long history where it is shown that by the time the Federal Reserve starts cutting interest rates in response to weakening employment, recessions, as denoted by the gray bars here, are rarely avoided. But beyond this, there's a few broader themes that have really been driving markets so far in 2025 that are worthy of deeper consideration. The first, unsurprisingly, is tariffs. So since the Liberation Day induced market crash in April, US stocks have surged around 35%, alongside pauses that followed in tariff implementation, trade deals, and softening rhetoric from the Trump administration. However, the effective tariff rate on US imports has continued to drift upwards in the last couple of quarters, now amounting to the largest increase since the Smoot-Hawley Act of 1930, which was imposed to protect farmers and other industries during the Great Depression. Now, there's a valid argument to use tariffs to reduce global supply chain vulnerabilities, to support domestic production in industries vital to national defense. But of course, the lessons of past tariff regimes in the US have been relatively unequivocal. At their most basic level, tariffs represent a tax. taxes curb consumer behavior, and they reduce economic output. They reduce imports, which initially can drive inflation through higher prices, and they generally induce retaliatory behavior, as seen most recently when China threatened to restrict rare metal access, where they control 90% of the world's supply. While the current effective tariff rate is estimated at about just 10% today, below the theoretical statutory rate of 19% that we see in green here. Now, this is due mostly to exemptions and shifting trade patterns, but the effective rate is likely to continue to trend upwards as enforcement rises and trade flows adjust in coming months. As a result, the impact will continue to be felt more fully across the US economy in coming quarters, even as inflationary pressures from tariffs have begun to register. Now, the surge in equity since April suggests quite little concern from investors for the current level of tariffs. However, the potential for additional retaliation, as well as the rising pressure of tariff-induced inflation, remains a source of risk that doesn't appear to be sufficiently factored into current market valuations. Now, the US fiscal situation has also been a major source of consternation in 2025. At about 6% of GDP, the US fiscal deficit remains at a spending level normally reserved for a stimulative response to a crisis or a recession, as opposed to when GDP is rising and unemployment is still low. Meanwhile, interest payments as a percentage of US federal expenditures has ballooned to 17%, despite an average interest rate on that debt of just 3.4%. This really underscores the concerns that the US deficit is on an unsustainable path, as debt service costs will continue to consume a larger percent of federal spending, especially if the debt has to be refinanced at higher rates in the future. Now, market commentators have pointed to the US dollar's 11% decline in the first half of 2025, which was the worst in 50 years, as well as the 60% year-to-date surge in gold prices as evidence of investor fear over this fiscal trajectory. But what's of key concern is that the US's high debt and deficit levels are risking a phenomenon that economists refer to as fiscal dominance. It's a situation where a country's monetary policy becomes subordinate to the government's fiscal needs as the central bank is pressured to lower interest rates or print money to help the US Treasury refinance its debt and keep interest service costs at reasonable levels. In doing so, however, it can sustain outsized government spending, it can reduce the central bank's independence, as well as its ability to raise interest rates to ward off inflationary pressures, potentially creating a dangerous dynamic for economic stability, savers, and household purchasing power. In recent quarters, the Trump administration has consistently pressured Fed Reserve Chairman Jay Powell to lower interest rates while pushing to install a new Fed chair for 2026 who's in favor of lower interest rates. In some respects, this current period is somewhat analogous to Richard Nixon's administration in the 1970s, where then Fed Chair Arthur Burns came under pressure to keep monetary policy looser than it probably should have been to accommodate government spending despite inflationary pressures within the economy. Alongside a backdrop of tariffs, the onshoring of domestic production, and ongoing geopolitical uncertainty, the current fiscal trajectory and the risk that the Federal Reserve may accommodate it increases the probability of future bouts of inflation. In the past, we've shared this chart. Now, we think that there's no certainty that this pattern has to repeat, but future inflationary risks shouldn't be casually dismissed either. From an investor's perspective, we believe that the uncertainty in the current policy outlook reinforces the need for a balanced allocation of capital in portfolio construction and the value of owning a diversified basket of equities whose businesses can offer a degree of inflation protection. Artificial intelligence is a third major theme that continues to dominate investor sentiment in 2025, and this isn't without reason, as since ChatGPT was launched in November 22, AI-related stocks have accounted for around 75% of the S&P 500's total return. The excitement, however, has intensified this year. In recent months, OpenAI, which is the owner of ChatGPT, signed a near unfathomable $1 trillion in deals with AI infrastructure and semiconductor suppliers, including NVIDIA, Oracle, AMD, and Broadcom. These announcements have resulted in enormous intraday surges in the stock prices for Oracle, AMD, and Broadcom, which cumulatively rose by nearly $500 billion in market value on the day the deals were announced. Now, for context, this is roughly equivalent to the entire market cap of Johnson & Johnson, one of the largest 20 companies in the S&P 500, and really just showcasing how willing investors are to instantly ascribe value to anything AI related in the current environment. Now, there's very little doubt AI is a profound technological development, and it will continue to rapidly proliferate in unanticipated ways for many years. However, amidst all this optimism, there remains a very high degree of uncertainty over how the market will evolve, who the eventual winners will be, and whether the unprecedented level of capital spending and the associated rise in corporate stock market value will be justified. Over the next few years, bottlenecks in critical infrastructure and power supply may prove a crucial limiting constraint on the continued scaling of AI compute capacity. Some estimates suggest that AI factories will contribute 55 gigawatts of net new compute capacity by the end of the decade. Other suggestions or estimates are more than double this. For reference, the Hoover Dam has a nameplate capacity of just 2 gigawatts. Delivering power generation and transmission to support such immense demand growth may well be a major challenge and a limiting factor over a relatively short time frame in the next few years. Additionally, an enormous amount of capital is being spent to construct these data centers, and there remains a large revenue shortfall which needs to be filled to justify this investment. Every 1 gigawatt of compute capacity costs around $50 billion to build. Cumulatively, this equates to around $2.8 trillion in expected capital spending for the next 4 to 5 years. This is just an astronomical amount of money, of which a major portion is in AI chips whose useful lives tend to be just a few years, especially given the risk that advances in software could drastically reduce the intensity of chip usage in advanced large language models, leading to a risk of overbuilding, of capacity, and potentially capital destruction. Meanwhile, consulting firm Bain & Company estimates that $2 trillion in AI industry revenue will be required to support the annual capital expenditure required to meet expected demand by 2030. But even under the assumption of IT budgets shifting to the cloud and substantial AI-related savings that are reinvested, they still estimate an $800 billion revenue shortfall. Together, this paints a very uncertain picture for the eventual return on around $3 trillion in capital being spent. How will it all be funded? Well, hyperscalers like Alphabet and Microsoft can largely rely on ongoing cash flow and balance sheets. The broader industry is increasingly turning to debt to fund capital expenditures with an estimated $140 billion in 2025, while 60% of all venture capital funding is now directed to AI investments versus 40% at the peak of the AI bubble, or the internet bubble rather. This rising reliance on huge amounts of external capital serves to magnify the risk profile of these companies' spending plans, as well as their vulnerability to recession and the volatility of capital markets. At the center of the funding question is OpenAI, who signed the $1 trillion in deals, but generates just $15 billion in revenue currently and loses billions every year. OpenAI intends to fund this gap through increasingly exotic financial relationships. It recently struck a so-called circular revenue relationship with AI chip provider NVIDIA, which will invest up to $100 billion in OpenAI, which OpenAI will then take to buy NVIDIA's chips. It also entered into a complicated relationship where it agreed to buy $90 billion of AMD's AI chips. In exchange, it will receive 10% of AMD's stock, which OpenAI could subsequently use as collateral to fund the purchase of AMD's chips, as long, of course, as AMD's stock price continues to rise. These are but a few of the interconnected web of relationships that AI companies have been spinning recently, which taken together amount to what appears to be a financial experiment on a grand scale. Now, in a number of respects, what's going on in AI has parallels to the dot-com bubble. In the late 90s, the rapid technological development of the internet led to this belief that there was insatiable demand for internet usage and networking equipment, which in turn fueled massive capital outlays, which were similarly came to be reliant on large external financing and circular revenue relationships with suppliers. The bubble eventually popped when it became clear that demand and revenue growth had been overestimated and a huge amount of capital deployed into networking and fiber optic cables that wouldn't be needed for many years. We don't pretend to know how this is all going to unfold, but it's likely and reasonable that AI may be in some stage of a bubble. What's less certain is how long it could last and how high it could go. But with central banks cutting interest rates today and AI demand still outstripping current supply, a further melt-up in equities is possible, even as the risk of a greater eventual decline in asset prices in the real economy has as well. Certainly, the environment today is far from the average. It's both one of the most expensive and concentrated markets in modern history, and investor sentiment has rarely been higher despite this. On this top chart, we're comparing the price-to-earnings ratio of the 2000 and 2021 market peaks to today. And on the bottom chart, we show the annual increase in the use of margin loans, which are used to speculate on rising stock prices, compared to the increase in the return of the S&P 500. Just think of it as a proxy for measuring the acceleration in speculative activity in the market. The real takeaway is that the S&P 500's valuation and the current surge we see in risk-taking are beginning to approach levels that have historically coincided with major market tops. Ironically, when investors are all crowded in one area of the stock market, it tends to create opportunity in other areas. Beneath the surface of a rising stock market this year, there's many areas that are still very attractively valued, and there's been a considerable amount of volatility, and that's created opportunity to buy new businesses and to add to existing businesses in our strategies, in some cases at levels which are typically reserved for recession. That our Canadian small cap strategy has benefited from 6 holdings being acquired in recent quarters at an average premium of 44% is, we think, one tangible representation of some of the underlying value that exists within QV strategies. While QV's funds have rarely kept pace in such narrow bull markets, they continue to generate reasonable returns in 2025 while maintaining a well-diversified contingent of stable, growing businesses that trade at a significant valuation discount to the global stock market. In future years, we continue to think this foundation of strong fundamental traits and our commitment to risk management should continue to offer acceptable return prospects despite a broader stock market that does look very expensive today. Thank you very much for coming tonight, and thank you for your ongoing trust in QV.